I will start this video by showing you a fairly shocking chart which gives you a straight idea of the situation. As you can see, $3 has never been so cheap, not even close. Welcome back to a new video. I am the Italian investor and today I will analyze $3, which has never been so cheap. $3 is one of the biggest retailers in the US and they sell house products, cosmetics, food, they sell almost everything. They are basically like a Walmart, but cheaper. They operate more than 8,000 $3 shops and more than 8,000 Family Dollar shops in the USA and 248 $3 stores in Canada. The main characteristic of these shops is that they sell very cheap products, mostly imported from China. This already is a little bit of a worry, because if import duties are gonna be risen in the next few years, this is gonna be a problem for $3. And things have not been so great in the past few years, as I will show you right now. But before, please remember to leave a like and subscribe to my YouTube channel if you're new. Thank you very much if you will. The big problem for $3 has been margins. As you can see, since 2014 it has been nothing but going south. They are getting worse almost every single year. This is a big problem, because it actually highlights a possibly worrisome business model. Because what differentiates this company from other retailers is the cheap prices, but with cheap prices often come low margins, and that's what's happening. Revenues instead are doing great. They are growing every single year. They never had a down year. And furthermore, there are other problems. As you can see, the company had to spend a lot of money to impair goodwill and for asset write-downs in the past year. And indeed, this year they are going through the closing of a lot of stores because they were performing pretty bad. This could be very good in the long term because it should improve margins. At least this is what they are hopeful of. In my opinion, this is actually a good decision. Keeping open bad stores doesn't make any sense, and it's dragging down margins. On a income statement profile, the company is not so great. Even return on capital is pretty low. So on a profitability standpoint, the company is not that great. And the balance sheet isn't any better. As you can see, they have $570 million in cash, but they have short-term debt of 1 billion and current portion of capital lease obligation of $1.5 billion. Long-term debt is also fairly high at $2.4 billion and capital leases are for $5.5 billion. So they have a lot of debt, but this is fine because this type of companies tend to have a lot of debt. And as you can see, the interest expense they pay on this debt is really low. For having almost $10 billion in total debt, they pay $100 million per year of interest expense, which is really good. They have some very good terms. So the debt situation is fairly fine for this type of company, but it's high if we consider that the company is not doing that amazingly. The cash generation is very good. Cash from operations is really high, but the company has to spend a lot of money in capex because the growth is all coming from new stores, so they need to spend. Maintenance capex is probably going to be around $600 million, something like that. This is something that needs to be kept in mind because it's important and makes a big difference. And then the company also buy back a lot of shares. As you can see, they have been pushing very hard in the past 5 years. So the cash flow statement is probably the best part of this company. So just to do a little recap, the company's profitability is getting worse, margins are getting thinner, but the company is trying to fix things, they are trying to improve, they are closing down bad stores, probably to try and improve margins, while they keep on expanding and opening new stores in better places, in potentially better places. The balance sheet is not that great, they have a lot of debt, but it's perfectly fine for such a company. And the cash generation is really good, but they spend a lot of money in capex, but this is expansion capex. As I told you, maintenance capex is probably a very small amount of that total capex, so the situation is fairly okay. And they do a lot of buybacks, which is really good. So now let's see if it could be worth a purchase, if this stock could be an interesting buy. I made a fairly conservative projection of revenues. I projected 2029 revenues of $35.5 billion, and I applied an EBIT margin of 5.5%. Here I'm being very conservative because I don't know if they are going to be able to improve margins, and in the past 10 years they have been going downhill. Therefore I cannot project an improvement, but I'm supposing they are going to be around this past 12 months level. Then I subtracted interest expenses and taxes to reach a net income of almost $1.4 billion, which would equal an EPS of 7.3 considering buybacks and stock-based compensation. I suppose that buybacks and SBC are going to be done at $105 per share. And this would take us to an EPS of 7.5 USD. In this I considered also SBC and buybacks at an average price of $87. So the stock at a 15 price earnings ratio could reach $112 per share, while at a 20 price earnings ratio it could reach around $150 per share. Here the thing is that margins are fairly thin and they're getting worse, so I wouldn't feel like applying a 20 price earnings ratio even though it's been the historical average. I think a level between 15 and 16 could be good for this type of company, which is a recession-proof company. So considering the worsening of margins, the high debt and the hardships they are going through, plus the inflation situation which is making things even harder, I wouldn't buy this stock right now. I would like to buy it at lower levels. But please let me know what you think about it. Type a comment and please remember to leave a like and subscribe to my YouTube channel if you're new. See you next time. Bye!